Greetings, Jonathan Camarda, Chief Investment Officer, coming to you from another post-volatile Fed week. Pretty densely packed, a lot of maneuvering. So I come to you bringing this video here on a Sunday. You'll probably get it sometime early this week when the tech team, who's always diligent, rolls it out. So where do we start? Well, we'll start where we called it a couple of sessions ago, a double shot of 75 basis point hikes. And we are looking that is pretty strong from the words of Jerome Powell after the move and during his press conference as well. Again, looking at just a hard mandate of, even though there will be pain, they will stick to their playbook of the 4% level, getting inflation down to the 2% level regardless. And we're already in a recession. We called that a couple of months ago. Again, nobody hits you over the head with this, but two straight declining quarters of GDP we've already seen, and we've seen a lot of retail and slowdowns in economic behavior and spending to the extent we look at inventories. On the other hand, we have had decently strong, just this past week, some manufacturing and service data, only giving a win to the sales of the Fed hawk. So it is a dichotomy, no doubt. Now, globally, the economic picture is much more dire. If you look at Europe, just hideous with the Ukrainian-Russia situation escalating still. Of course, the agricultural energy issues there. You saw the recent news out of Germany. I won't get into details on this cast here, but you can do some digging there. And they are in a world of hurt. Now, you'll notice that the global banks now are raising rates. They almost have to, because the dollar is getting so out of control to the upside versus global currencies. They have to raise rates as well. And of course, they're driving their own economies over the cliff. So it is not nearly as bad here as it is globally. But that's not a great thing for us domestically as well, right? The strong dollar, which many of you have been taking advantage in the active capital preservation strategies, sector momentum, as well as some of the others, has been one of the winningest trades this year, and it continues to get stronger. Now, that is a negative for equities, and certainly has been a negative for treasuries and bonds as well. As rates have gone up, the dollar's gotten stronger, right? We've had a confluence of bonds and equities going down for the first time like this, and for whoever could remember, really going back decades, which has increased the use of alternative assets, which can deflect some of the volatility, and you've seen that in many of your strategies as well, with different positions that we've had. So where we say things right now, the markets, the Dow, S&P, and NASDAQ are all below their 50 and 200-day moving averages, which is why in a more fundamentally buy and hold strategy like opportunistic growth and income, you saw some shedding of percentages there to nearly half our exposure, because when both all three indices are below both moving averages, the 50 and 200-day moving average, with confluence of an unaccommodative Fed, we need to take cover because most of the pain may not be behind us. We don't know, but certainly we're hedging in that direction, especially in this time of year with everything else. Now, if the dollar does take a shot to the downside, as these global banks raise their own rates, that would be a relief rally for equities. But again, just like every other relief rally, it would be a sellable rally, not necessarily base camp for a new hit, at least at this juncture. So what that means, again, is we continue to be eternally vigilant. Over the last month since Jackson Hole, the markets are all down hard into the double-digit area since that mid-August high, and our clients have participated 25-30% maybe of that fully. Very little volatility compared to the markets, because we started playing defense back in August, forecasting this. And if you watch some of the casts, you'll see with some of our views and what we were getting through the institutional pipelines and such, that light at the end of the tunnel was looking like it was coming at us, and it was not the sun. So with that being said, we continue to be defensive as we move through now into the early part of the fourth quarter. Again, and some of the more active strategies, like your sector, your global macro, your velocity raptors and such, will take shots. While some of your more conservative strategies this time of year, like macro momentum, which is seasonally based, which has worked out great, right, is basically heavy cash in a shell, so to speak, with some overnight treasury obligations that are earning quite a tidy sum compared to the bank. So very attractive from that standpoint on the down days, and we shall see what Q4 brings. Now, again, we said it last time. Again, we're still looking for 75 basis points not to go Vegas, watching behind me here what the odds are. I don't know what Bulldog's saying about that, but I'm thinking 75 basis points again for Uncle Jerry there. And if you listen to the Hawks, that they are on a march. Now, I will say that will bring the pain that he's talked about to many sectors of the economy, especially small businesses and individuals, where the cost of everything's going up, and now you're squeezing, credit as well. And so very, very treacherous times. In fact, some of the large managers of some of the large institutional funds you've seen, I mentioned last time as well, are calling that this will not be an easy landing. We're talking about the runway getting dug up. As this plane starts to, curve worse than remember the old classic airplane, won't quote any quotes there, from what was it, 1980 or so. It could be a bumpy ride, as Betty Davis said, so buckle up. And that's what we are. You're already buckled up, and we might continue to tighten that buckle in all seriousness. Again, if your individual situation dictates changes, say it every time, like a broken record, but it's immensely important because it's your money. You earned it. We're just privileged to look over it, for you, and we take that very, very seriously. Talk to your personal wealth advisor to match up, again, your own risk appetite with how the models are adapting to the current environment. And then also, as we go through Q4, your personal wealth advisors will be discussing your IRA accounts that need to have required minimum distributions and as such. And again, contact them if you want to make any proactive plans. Other than that, again, we also have, besides the financial storms, those of us here in the Southeast, especially in FLA, looking at, I believe it's Ian. Is it Ian? I don't know. But certainly that is looking pretty treacherous as well. So certainly keep safe as well. We'll look over after your money. Just look over after your loved ones and yourself, as the volatility weather-wise kicks up as well. Till next time, it's a pleasure. Jonathan Camarda, stay frosty. Again, we appreciate your time, patience, and most importantly, your trust. Godspeed.